Hello everyone, welcome to my transpricing series. So, whenever we hear the term transpricing, many of us immediately think of complicated tax laws, OECD guidelines, documentation requirements. So, but before understanding all these technical concepts, first we understand why this transfer pricing came into existence. If government had never introduced the transfer pricing rules, what would have happened? So first let's understand the transfer pricing in a very simplest possible way. So basically transfer pricing, if you want the definition, transfer pricing is the price charged for the goods or services or intangibles or financial transactions between related entities within the same group. So for example, there is a limited company which manufactures shoes. So, A Limited is in India only. So, A Limited is manufacturing shoes and selling the customers in India at 150. So, they are manufacturing the shoes at a cost of 100. So, they are selling at 150. So, they are getting a profit of 50 and they are paying tax at 30% in India. So, 15 to 30 percentage. 5 threes are 15. So, 15 rupees is the profit they are paying, right? So, same A Limited, the same manufacturing company, has its manufacturing division in India and its distribution division in, for example, UAE. So, Indian company, same selling their manufacturing output to the UAE company at 150, and the UAE division is selling to the local customers at, for example, they are adding their margin and selling it at 200. So Indian company, for example, they got a profit of 50 as they are selling at 150. So 50 on 50 they are paying 30% tax rate. 15 at UAE, on 50 they are paying 9% tax. 4.5, 15 to 9 percentage. Yes, 4.5. So in India they're paying it 15. At UAE they are paying 4.5. So 19.5 is the overall tax they are paying. So and overall profit they got in India 50 and UAE 50 100. So as they internally, the A Limited understood that as they are, there is no price to set. They can decide their internal transfer price. So they realized that if I sell the UAE division, the distribution division at a lesser price, and they can sell to UAE customers at 200 only, but then they can reduce the tax in India and they can pay less tax in UAE. For example, same A Limited company, which is manufacturing shoes at a cost of 100, and they are transferring it to their distribution division at a price of, for example, 105, a minimal profit. So they got in India, they'll show their profit at 5 rupees and they can pay 30% tax, that is 1.5 in India. And the same UAE division selling to their ultimate customers at 200. So they are getting 95 rupees profit. On 95 they are paying it 9 percentage. I don't know how much 95 into 9 percentage. Uh, will do that. 95 into 9 percentage, so they got 8.55. So here 8.55 they are paying, and at India they are paying it 1.5. So 8.55 plus 1.5, they're paying it 10.05 is the overall profit. The overall tax they are paying 10 rupees. In previous case they are paying it 19.5. So ultimately they are getting tax saving. So the all the companies who has multiple like presence in different countries, or the entities which are operating in multiple in countries, they are following this rule. So This is called profit shifting, as they are shifting Indian company profits to UAE. So whatever this thing they are followed is called profit shifting. So then the government realized, okay, multinational companies are shifting profits to low tax countries. So because of this, the like countries like India, is losing profit. Like basically, the government is losing its revenue. So that's the reason they introduced transfer pricing. So basically, first they introduced this with a basic principle. What if the same transaction is happened between two unrelated parties? What is the price charge? The same price to be charged between the related parties. So the main rule is, they said that the related entities should behave like an independent parties. So this is called arm's length principle. So this is how transfer pricing came into existence. So basically, they want to what? So the basically the problems the government is observed is profit shifting. So as a solution to this profit shifting, they introduced arm's length principle. So the main objective is like whenever two related companies transact with each other, so they should behave as if they were independent companies. So this is, for example, same Indian company manufacturing, and if they sell it to the Indian customers only, what is the price? For example, if they sell same distributing units in India only, they'll sell it 150. So the arm's length price is a 150 instead of 105. If they are selling at 105, then that is not, there is no fair price. So that's how arm's length principle got came into existence. And many people think that transfer pricing is applicable to only to goods. No, it is applicable to all type of transactions: sale of goods, purchase of goods, consultancy services, IT services, management services, royalty payments, loans, corporate guarantee, and basically any transaction between a related parties or associated enterprises. So and transpricing is not about giving equal profits to all the entities. So for example, in a group, A limited is there in India, B limited is there in China, C limited is there in the UAE, some other something like that. Then it's not about giving equal profits to A limited, B limited, C limited. Transpricing is about giving each company the profit that it deserves based on the functions performed, assets used, and risk assumed. This is called FAR analysis. We'll discuss about this concept in upcoming videos. So this is all about transfer pricing, why it came into existence. Later on, OECD drafted deeper regulations to prevent inconsistencies and avoid double taxation and all. So basically, transfer pricing was not created to collect more tax. It was created to prevent artificial shifting of profits from one country to another. Thank you. I hope you like this video. If you found this useful, please like, share, and subscribe. See you every Thursday at 7 p.m.